Brent crude just shed over $3 in a single session. Not because of a supply glut, because of a rumor. A rumor that the United States is close to a nuclear deal with Iran. And here is the trap. The market is pricing total de-escalation as if every barrel of Iranian crude has already hit the water. But I see something different. In the next 30 seconds, I'll show you the one danger zone and the one hidden opportunity right now. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. This is your instant market verdict. The intraday and daily trend is a strong sell, no debate. Oil is in a free fall, accelerating lower through all short-term moving averages. But here is what the herd is missing. The monthly chart is still a strong buy. This panic is attacking structural support inside a multi-month value area. That means the sell-off is tactical, not yet structural. The single invalidation level that flips everything is $84.38. Write this number down. If Brent closes below 84.38 on the daily timeframe, the 200-day moving average and major support zone that held every major low this year is gone. At that point, the entire bullish structure from the 60s resets to a bear market. Keep your eyes locked there. Right now, the herd is aggressively short, momentum chasing the headlines. When everyone leans one way, the snapback becomes a liquidation grenade. Do not be on the wrong side when it detonates. Let's zoom out and do the technical deep dive. On the weekly chart, we are in a sell trend after rejecting the 95.80 resistance. That level was the cap that killed the rally. The 20-week moving average around 95.55 has been lost decisively, and the 100-week moving average at 91.88 was sliced through like butter today. Price is now hovering just above the 200-week moving average at 83.98. That 200-week line is the floor that has contained every serious liquidation since 2021. Drop to the daily. We are trading below every short-term average. MA5 at 90.63, MA10 at 92.66, MA20 at 95.55, MA50 at 96.34. The MA200 at 83.98 is the low-frequency spine of the entire trend. The daily RSI is at 35.8, not yet deeply oversold, but the daily CCI at -241 is screaming extreme. This is a condition where price often snaps back to the 5-day moving average near $90.60 before making its next real decision. That is your mean reversion target. On momentum, the daily MACD is accelerating lower at -2.88 with no divergence yet, so bearish momentum is intact. But now go to the 4-hour and the 60-minute. The hourly Williams %R is pinned at -93. That is a coiled spring. Stochastics are at 41, beginning to curl. Here is what most traders miss. The sell-off was triggered by a headline, not a fundamental glut. That means the break of the 91.44 pivot and the plunge through S1 support at 88.74 were technically driven by stops running. The next major support is S2 at 87.07, which we have already tested. Intraday. We are breathing right at that zone. If we lose 87.07 with conviction, S3 at 84.38 becomes the magnet. That S3 level confluences exactly with the 200-day moving average and the psychological round number. The battlefield is clean. Support cluster at 87.07 to 87.33, then the 84.38 floor. Resistance sits at 88.74 former S1, then the pivot at 91.44, then the death zone of 94.14 to 95.80. While gold and bonds rallied on risk-off, oil decoupled entirely. Oil is acting purely as the geopolitical heartbeat, not an inflation proxy. The heartbeat just flatlined on de-escalation news, now the fundamental driver and cross-linkage. Yesterday's news changed the entire risk profile. Trump told Israel to stop attacks in Lebanon, and the U.S. is reportedly near a deal with Iran. That is a double barrel of de-escalation. Reduced immediate supply disruption risk in the region and a potential pathway to lift sanctions on Iranian barrels. The market immediately priced out the war bid. But here is the rub. The deal is not signed. Trust is razor thin. Any breakdown in talks and the premium floods back in $3 jumps. So we are trading headline risk, not physical barrels. Brent's correlation with the S&P 500 flipped negative this session. Equities slightly higher on tech while oil tanks, proving the risk asset shadow has broken for crude. Oil is a pure geopolitical decompression trade. The 1 to 2 week directional lean is a continued grind toward 84.38 unless we see a daily close back above the 91.44 pivot. That pivot is the line that would say the deal premium is being questioned. The event that invalidates the bearish lean is a sharp headline signaling Iran rejected terms or a fresh escalation. Do you think Brent closes below 84.38 this week? Comment below 84 or bounce right now. I am tracking consensus. Most people skip this next section. That is exactly where the money is made. Keep watching because I am giving you 3 trade setups with exact triggers, stops, and risk-reward ratios. Strategy 1, the sniper, conservative. We are not chasing the freefall. The sniper waits for a countertrend bounce to re-enter short from a better location. Trigger condition, an hourly close above 88.74, the former S1 now resistance. Wait for a bearish rejection candle on the 1-hour chart, such as a shooting star or bearish engulfing. Entry around 88.70. Stop loss at 89.55, just above the MA5 and a recent minor swing high. Take profit 1 at 87.10, which is the S2 support test, giving a risk reward of approximately 1 to 1.5. Take profit 2 at 85.50, just above the 200-hour moving average, taking the ratio to 1 to 3. Invalidation. The entire bearish setup is void if we get a 4-hour candle close above the 91.44 pivot. If that happens, the structure has shifted and we step aside the sniper, conservative, entry, 88.70 on 1H bearish rejection of 88.74 stop loss, 89.55 take profit 1, 87.10 take profit 2, 85.50 risk, reward, 1:3.2 hour invalidation, void if 4H. Close above 91.44 strategy 2, the active trader, standard. This is the mean reversion long that exploits the rubber band snap. Given deeply oversold hourly conditions, we can look for a long from the 87.07 support. Trigger, a 1-hour close above 87.10 following a wick down to 87.00, and confirmed by a bullish divergence on the 15-minute RSI. Entry at 87.15. Stop loss under today's low at 86.45, tight and logical. Take profit 1 at 88.74, the first resistance. Take profit 2 at 90.60, the 5-day moving average and the natural mean reversion magnet. Once TP1 is hit, move your stop to break even and trail by 50 cents. This setup has a risk of about 70 cents against a reward of over $3 if TP2 is reached. Invalidation. If an hourly candle closes below 86.45, the trapdoor to 84.38 is open. Cut it instantly. Type your Brent high-low range for tomorrow in the comments now. Let's see who is aligned. The active trader, standard, entry, 87.15. 1H close above 87.10 plus 15M bullish RSI divergence, stop loss, 86.45 take profit 1, 88.74 take profit 2, 90.60 trail, move stop to break even after TP1 hit, trail by $0.50 invalidation, void if 1H close below 86.45 strategy 3, the aggressor, high risk. This is for adrenaline and only for those who can lose small and manage risk aggressively. If we see a rapid spike down to the 84.38 to 84.00 zone, that is the 200 DMA, S3, and the bull market spine. The aggressor can buy with a limit order at 84.50. Stop loss at 83.70, below the structural low and the 200-week moving average. Target a fast bounce to 87.00, giving a risk reward of roughly 1 to 3. This is catching a falling knife. If price spends more than 15 minutes below 83.80, The floor is gone and you must get out. No exceptions. Only size this trade for a loss you can comfortably accept: the aggressor, high risk, entry, 84.50 limit buy stop loss, 83.70 take profit, 87.00 risk, EA reward, 1:3.3 R invalidation, 15-minute candle closed below 83.80 never risk more than 1 to 2% per trade. No positions through high-impact news events like the nuclear talk statements. Stops are non-negotiable. This is how you survive to trade the next explosive move. The single most critical level for the next session remains 84.38. A daily close below that number opens the trapdoor toward $80 and changes the medium-term trend. A hold and reversal back above 88.74 would signal the deal premium is fading and shorts are in trouble. Tomorrow, I am watching the weekly U.S. rig count and any Vienna headlines. I will also be covering the S&P 500 gamma wall and Bitcoin's breakdown correlation. That video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.